So welcome back, guys. Today I'm going to try as much as I can to explain the simplest way in which to understand market structure. So I shall start by drawing, let's say, market is in an uptrend, right? So it makes uh, higher, market is making higher highs and higher lows. So this is an uptrend, right? So at this point in the market, we have entries. So this can be an entry for buyers to push the price even higher. That means price, let's say the current price was at $80. Let's say this is maybe like a stock, and the price was at $80 at point A. This is point A, and this is point B. So point A to point B. So at B, price was at 100, right? So that means that buyers came in and they were because of the furious buying, they took the price from $80 to $100. So this zone here where buyers enter into the market, this is called a demand zone. It's simply an area in the market where entries for buyers are executed, right? So at this point, buyers enter the market and push the price even higher, breaking the first higher high that was made to create a new higher high. So let's erase this. So when market makes a higher high, market makes a higher high. So that means this was the first higher high, and market came in and removed it, right? So this was the first higher high, and then market pushed through that point to create a new higher high. So at this point where price pushed through, we can look for entry models for buyers for a consolidation to that point before price pushes all the way up. Now there are tools for getting entries. There's what they call, there's Fibonacci. I don't know if that's SP. Fibonacci. Oh, there's a Fibonacci whereby you simply get your fib levels. Maybe this was the let's be quick. Let's say I had your level marked out. So this was the first entry for buyers. They pushed the price all the way up, came back for a retracement, and then they went all the way up. So what does that mean? That means that if we're to look for entries, to sell or to stacking positions for a buy, we simply get the previous low, and then we go to the previous high up to the most recent high. So we put our fib at these 2 points from the recent low to the most recent high, right? Just put our fib at that level. So our fib could in consequence be from there up to here. And what the fib will do for us is that it will get for us entries so that we can catch this move here. So if price, as we are saying, price makes higher highs and higher lows. So this is of course an uptrend. So in this uptrend, as I've said, you can use fib levels. For instance, if this is a 50 fib level, you can simply look for entries to go higher and shoot above this support, above this previous high. That is if prices continue in the bullish momentum, in a bullish trend, right? So why do prices go up? I'll answer that in just a simple manner, right? So let's say we have a product. Let's call that product X, right? So when we have massive orders, let's say one buyer comes and takes one buyer comes into the market and wants to buy the product X at, so I'll share A. Let's say our buyer A wants to buy the X at maybe, let's say, $2, right? And another buyer B wants to buy X at, let's say, $3, right? So if the overall demand for X, if let's say more buyers are to come into the market, right, and they want to buy X at the cheapest price, right? So they want to buy X at the cheapest price. But remember, there are many buyers at this point. When there are too many buyers at this point, what happens? Since X is limited, let's say that X can be gold. If there's limited supply for that product, right? If there's literally limited supply, if X has a limited supply, for instance, gold itself, right? What will happen is simply that prices will be pushed up. Where it would have been bought at $3 or two, now it now be pushed to 5, right? So that may mean that this was the initial entry. Let's say this is our buyer A, and he bought the product, let's say at $2, right? At $2. Then buyer B came in and pushed the price because of the higher demand. The price was pushed up to $3, right? But now because more people came into the market trying to get X, that product X, for a very for because they wanted to buy X, right? That means that there's gonna be a higher demand that can be fulfilled at that moment. So many people want to buy X, so there are many buyers. Buyers are greater than sellers. In other words, we have demand is greater than supply. So our demand is greater than the supply. When this happens, prices are pushed up. That's how we get higher prices. So in that example, from that example, all you have to do is that if we go to our market, you can see that if this was our product X, if more people came in to buy X, its price will be pushed up higher and higher. which in turn means that there's going to come a point whereby there is maximum buying pressure. So we can call it maximum buying pressure, MBP, right? So this is when we have our last bullish run, but we shall discuss that later in the video. So the very first thing you have to notice is that when prices push up, when prices keep on pushing up, that means buyers are entering into the market at a certain point. Let's say this is the first point they enter into the market, because we see that price retraces. First of all, as you can see here, price retraced. It had made a previous move to the upside, but then came back, right? So at this point where it pushes, it gains momentum and pushes up. That's our demand zone. This is where most buyers now are entering into the market to buy more of the product X, which I used X as an example. So that means that since more buyers have come in and pushed the price even higher, there is a high probability that if price comes lower, let's say, let me first remove this part here. So let's say, let me first remove the trend line itself. Okay, let's say price actually pushes up, right? Now, since this is the demand zone, there's a high probability that if price came back to this zone, there's a high probability that the buyers who are able to push the price higher can at this very point push it even higher. So that's the strategy if you want to use supply and demand, right? So the buyers who were able to push the price even higher at that point, there's a high probability that they will come into the market to push it even higher when price comes to those areas. Why? Because we recently saw that many buyers at that point, that was their entry. That is the price at which they were willing to buy that given product. So in supply and demand, our main area of confluence is simply having to wait for price to come into our zone, then we take trades based off that. Now, as I was still saying, is that for a bullish trend to continue even higher, price has to continue making higher highs and higher lows, right? So in a bullish trend, price is being pushed up even higher because there is demand for that product greater than the supply. So let's say this is the price of price X. This is price. So it starts at 0, maybe like up to 8, right? So price keeps pushing up, maybe it can even come down, consolidates a bit, then pushes all the way up to that maximum buying pressure, right? So at this point, we can say that now supply comes into the market. So when we say that supply comes into the market, it means that the sellers of that product X have now got more of the product itself. When they get more of the product, supply is going to be greater. If supply is greater than demand, that means that sellers are now greater than the buyers, right? What does that mean? That means if someone, for instance, bought at a cheaper price, let's say at the start here, someone was going to had bought the product X at a given price, let's say at a $3, which we started with. Let me first delete most of this. So if someone bought at $3, right? If someone bought at $3, so someone bought at $3 for product X at time T, right? And then the price pushes up to, let's say, $80, right? For every unit of X, for every unit of X, right? That means that that person, when We have maximum buying pressure when there are sellers now entering into the market to create a supply zone. So this is a supply zone. When these sellers enter into the market, there's now more supply. If the supply is greater, they're going to push price all the way down. Now, as they push price all the way down, we know that the person who actually had made a profit from, let's say, $3, when price reaches $8, he starts selling. So when he starts selling at this point, then he creates a demand zone, a supply zone, because that's where now we have most of the selling pressure. So for that matter, we shall see a drop in price at this point, right? So price will drop at that point. So if price was moving up, right, making higher highs, consolidating higher highs, and then it reached this point whereby there was a supply zone, then it drops massively. Now there's a high probability that when market comes back to that same point in the future, it's going to also drop massively. So as in trading, as in any area of life, there is what they call probabilities. So in probabilistic trading, we're simply looking for entries or models whereby there's a high probability that one outcome will happen over the other. So at this point in the market, there's a high probability that there will be more sellers at this very point in the future than buyers, right? So that's why they call it a probabilistic model. So we are simply trying to get as many probability confluences on our side as possible. We're trying to get as many things that agree with our setup as possible. So yeah, that's the basics of trading. I'll be explaining more in more videos, so be sure to subscribe to my channel and I'll keep you guys updated. Thank you.